Hi students, my name is Chris and I'm an accounting tutor with Chegg Tutoring. In today's tutorial, we're going to review working capital. Working capital is a critical measure of liquidity for a company, and it's defined simply as current assets minus current liabilities. The amount of working capital can be either positive or negative. So let's look at the components of what makes up working capital. Current assets are the most liquid of assets. They include cash, accounts receivable, and inventory. Current liabilities are defined as any obligations that are due within 1 year. They would include accounts payable, accrued expenses, short-term loans, or notes payable. If working capital is positive, it means the company has enough current assets to meet its short-term liabilities. If working capital is negative, then that means the company could have trouble in fulfilling its short-term liabilities, depending on a number of additional factors, such as cash flow or operating margins. Working capital is also a good indication of operational efficiency. For instance, excess inventory or slow accounts receivable collections are signs of inefficiency that will appear as increases in working capital over time. Optimal working capital management requires management to constantly monitor current assets and current liabilities. For example, the longer it takes to buy or manufacture goods, the more working capital a company needs. If they can receive, for instance, raw materials in 3 weeks, then the company needs to hold less inventory than it would if there was a month lead time for those same raw materials. Also, businesses that are seasonal or cyclical often require more working capital to stay afloat during the off season. So while a company may make more than enough to meet their short-term obligations yearly, it has to ensure that it has enough working capital at any one point to meet its short-term obligations. For instance, a company that may do significantly more business over the holidays, resulting in large payoffs at the end of the year. But the company has to have enough working capital to buy inventory, cover payroll, and other expenses during the off season as well, when revenues may not be as high. So what are the sources of working capital? Well, net income, proceeds from long-term loans, sales of fixed assets, as well as capital infusions from stockholders. What a sufficient amount of working capital allows a company to do is maybe seize on unexpected business opportunities, perhaps an acquisition or some type of equipment purchase. It can mean that a company can qualify for bank loans. It also means that a company can receive favorable trade credit terms. So that's a discussion on working capital. If you have questions or need additional information regarding a concept of working capital, my link is below. Feel free to contact me on Chegg Tutors. If you also have need any help with other accounting topics or issues, again, please feel free to contact me. Thanks very much for your time, and I look forward to speaking with you soon on another tutorial.